the Fed is going to be cutting rates with everything going really bananas in terms of the markets. We
Yeah.
have time highs. We've got gold and silver gold at all-time highs, silver at 14-year highs. What else? We've got the crypto, Bitcoin craze. Yeah, do they really need to cut rates? It could trigger, I've spoken a lot about the crack up boom. That could be the trigger. We could see everything go up, and that would be more a sign of a weaker currency than anything else. So yeah, we could be on the road to really interesting moves higher.
Mario Innecco believes we've reached another turning point in monetary policy, and the implications for gold are hard to ignore. Central banks appear set to pause quantitative tightening and move back towards stimulus, a shift that's already showing up in steeper gains for the metal. Investors feel the weight of trading paper money for hard assets, but momentum is on gold's side. Miners, too, remain historically undervalued relative to the upside if gold holds its ground or breaks higher. History gives the playbook. After the Fed cut rates in 2007, gold ripped to new highs before retracing, only to soar again once quantitative easing came into play. Within a few years, it had tripled. Even during tightening phases in the 2000s, gold trended upward, proof that distrust in fiat outweighed whatever policy the Fed announced. That same distrust has only grown louder today, as not only foreign holders but also domestic investors question the dollar's staying power. Portfolio allocations tell the story. While some analysts now call for 10 to 15% exposure to gold, the U.S. average still sits near 1%. That leaves a vast amount of capital that could rotate into metals once confidence in paper assets erodes further. Innecco says we're entering a phase where weakening trust in currency collides with strengthening demand for hard assets. For miners, that means amplified leverage beyond the metals themselves. The only real question is whether investors will move early or wait until inflation makes the rotation into gold impossible to ignore. If you found value in this breakdown, please hit the like button, subscribe, and share it with other investors who are paying attention. We're here to keep bringing you sharp analysis and voices that actually understand what's unfolding. Thanks for watching.
There will be even more aggressive. They'll cut. They'll probably stop the QT that they're still doing. Then they'll start QE. So I'm not surprised that gold is taking off, and that consolidation we had since April, that's been broken out and is getting steeper and steeper. So yeah, I'm holding on to my gold, my silver, trying to add on. It's getting more and more difficult because you need more and more fiat to exchange for them. And also the miners, they look very good as well. Yeah, so that's how I see the markets for now. 2007 cut, and gold was at 660 or so.
Yep.
And by March, after they started cutting, it reached an all-time high of 1,032.
Yep.
And that was the day that Bear Stearns had to be bailed out by the Fed and JP Morgan, and gold topped there. And then it bottomed at 700, well, 680.
Yeah, 700.
Yeah, when Lehman collapsed. And then they announced QE, and it just took off to 1900 by 2011. So yeah, no, and even if you look at in the 2000s, even when they started raising rates there, I think 2004, gold kept going up.
Yep.
So yeah, and so yeah, I'm still very bearish fiat currencies, i.e. bullish gold. Yeah, it seems to me now that gold is moving. Yeah, the monetary policy and fiscal policy, they both do affect the price of gold. But I think the other thing that's moving gold is the loss of confidence in the dollar as a reserve asset, and not just by foreigners, but also domestic investors. I saw Ray Dalio just came out and said that investors should hold 10 to 15% of their assets in gold, which is quite big. also considering that on average, U.S. investors only hold 1% of their assets in gold, and worldwide that number is more like 0.6%. So yeah, a lot of room. Well, right now, I mean, anything can happen, but the oil market seems to be pretty depressed,
Hmm.
and with the prospects for the economy slowing down, not just in the US, but in other countries, it's probably going to remain there. The other thing could be geopolitical. The Russians and OPEC know that a price around 60 or below 60 is really bad for the fracking sector in the US. So I think they have a much bigger, how can I say, um, wherewithal. They have a lot more wherewithal, OPEC and OPEC plus, to keep. Yeah, they'd like higher oil prices, but I've noticed that recently they've been increasing production, and I think it's a war against the fracking industry in the U.S.
Mm.
The fracking industry, uh, yeah, could be in real trouble, and so that's why I think oil prices are going to stay pretty steady, and that's going to continue to help the miners. And not only that, Danny, but I think a lot of the miners are still investors don't realize how cheap they are in terms of I think the analysts or the investors or they're accounting for gold at a lot lower price. They're always very conservative, but if gold stays firm, as I think it will, or goes even higher, that's going to put an even bigger rocket up the mining stocks, I think, not just the oil price. In the 70s, there were three waves of, well, I don't like to call it inflation, but rising prices, because
Right.
CPI is, but let's call it inflation, and I think late 60s to like 73, 74, and then went down and up and downs. And I think next year, uh, what gold is telling us, and silver, is that prices are going to rise quickly again. And I think it makes sense because, as I said earlier, everything's booming, and they're going to cut rates. That's going to fire up liquidity even more. And more liquidity is basically inflation. It's creating currency and credit out of thin air, and it's going to have to go somewhere. It's going to go into assets, but it could go into consumer, especially consumer goods, basic necessities. Yeah, it might even bring oil up a little bit, but I think oil is still really cheap for gold miners. So even if it goes up 10, 20%, but the price of gold goes up 30, 40, it doesn't really make too much difference. So yeah, I think we're going to get a second wave of inflation, if you want to call it
Mm.
that, from 2026, because in the 70s we had three waves. So all these things come in waves. Yeah, that's the way I see it.
Mario Innecco warns that central banks are being pushed toward rate cuts because the economy is quietly unraveling. On the surface, US GDP looks fine, but that stability is almost entirely the result of massive government deficit spending, now running near 7% of GDP. Strip that away, and the economy would already be shrinking. The labor market isn't holding up either. Jobless claims just hit their highest in 2 years, and payroll numbers have been revised sharply lower. Back in 2022, officials dismissed recession fears by pointing to strong jobs data. Now those same figures are being corrected downward by hundreds of thousands, which makes it difficult to take official statistics at face value. Alternative trackers like ShadowStats suggest real inflation is running closer to 10 to 12%, not the 3% headline numbers. That's why Innecco thinks rate cuts are inevitable and possibly aggressive. A jumbo 50 to 75 basis point cut is not out of the question, but history shows those kinds of moves often arrive just before a crisis. The dot-com bust followed in 2000, the housing collapse in 2007. Today, the weak spot could be subprime auto loans. One large lender has already gone bankrupt, and with $1.6 trillion in total auto debt outstanding, the risk of contagion is real. Let's get back to the interview.
If you look at CPI, almost 3%. If you use the rule of 72, which is you take the percentage and divide it into 72, you get 24, which is, it takes 24 years at 3% CPI to have the value of the currency. So yesterday, President Trump and the White House tweeted or posted on X that there was no inflation, which is really, in my opinion, not, it's a bit dishonest, really. But I guess you can understand they're politicians. But so I think the debasement of the dollar is going to continue, and it's happening all over the world. But the central bankers are desperate to cut rates because things are slowing down economically, and the only reason the GDP is fairly firm in the U.S. is because the budget deficit to GDP is running at 7%. So if you strip out all the government spending, all that extra, like 7%, GDP would be negative because GDP adds government spending. As for the jobless claims, I thought it was a really weak number because I keep track on investing.com. They have a little chart going back 1, 2, 5 years and maximum. And I did it for 2 years, and the 263,000 claims last week, that's the highest in 2 years. So the previous was 260. That's a bad sign for the jobs market. And that will mean that the Fed will, well, they will definitely cut. That's expected. But I think they might cut by 50 or 75, which is like a jumbo cut. That's
Yeah.
what Fed Governor Waller said a couple of weeks ago, depending on the data. And the data are starting to look quite weak. We saw the other day they revised the non-farm payroll by 911,000 lower from March last year to March this year. Previous year was something like 800,000. And I don't know if you remember, Danny, back in 2022, there were 2 consecutive quarters of negative GDP, which is usually recession. But they said, oh, it's not a recession because the jobs market is so strong. But now we know that it's all a lie, basically, that they've just been overestimating the jobs market to manipulate the markets. And then eventually, like 18 months later, it's all revised lower. So to be honest, I'm not sure whether we can trust any of the numbers, except that CPI is probably a lot higher than it is. I suggest people look at shadowstats.com. John Williams has a really good service there where he looks back at CPI, how they used to calculate it in 1980 or 1990. And according to him, the currency or the CPI, well, currency debasement or CPI is running more at 10, 12%. So, that's how I see things. I mean, both of these cuts they were precursors to a crisis, like back in 2000, it was the dot-com bubble bursting. In 07, it was the subprime housing market bringing down the whole housing market.
Mhm.
And the question is, what is it going to be this time? Actually, it could be another subprime market. I just saw a story about subprime auto loans that a big lender called Tricolor just filed for bankruptcy. Yes, the subprime auto loan market is very small, 80 billion, but so was the subprime housing market. I don't know if you remember Ben Bernanke,
Mhm.
late 2007, he said the subprime market is contained. It's not going to spill over into the housing market. He said housing never goes down nationally. And then lo and behold, everything
Mhm.
fell out of bed. So they're saying, I read the article on Bloomberg today, and they said, oh, the subprime auto loan market is very small, so it should be fine. But the the whole auto loan market is almost 1.6 trillion. So who knows, that might be the trigger, or something geopolitical. I don't know. But the other thing, Danny, is that the Fed is going to be cutting rates, with everything going really bananas in terms of the markets. We
Yeah.
have time highs. We've got gold and silver gold at all-time highs, silver at 14-year highs. What else? We've got the crypto Bitcoin craze. Yeah, do they really need to cut rates? It could trigger. I've spoken a lot about the crack up boom. That could be the trigger. We could see everything go up, and that would be more a sign of a weaker currency than anything else. So yeah, we could be on the road to really interesting interesting moves higher. I mean, it will favor, of course, the top 1%, the top 10%. I mean, the bottom 50% of Americans hardly own any assets. And I think it's just going to make it harder and harder on these people to get through it.
Cycles in money and credit often rhyme, and the current moment feels like another verse of the same song. Deficit-driven growth, weakening labor numbers, and quietly mounting stresses in consumer credit all point to policymakers reaching once again for lower rates and fresh stimulus. Gold is already responding, reflecting not only expectations of looser monetary conditions but also the deeper unease about the durability of paper promises. Mining shares, undervalued relative to the potential embedded in higher bullion prices, stand to magnify any continued move in the metal. What makes this moment distinct is how broad the distrust has become. Not just foreign governments, but domestic savers are starting to look at gold as insurance against a system that repeatedly leans on currency creation to paper over cracks. If history is any guide, the eventual policy pivot may spark rallies in metals long before the broader public acknowledges the inflationary cost. So stay tuned. If you're into real, data-backed takes on the financial system, hit like and subscribe so you don't miss the weekly updates. Thank you for the support, and I hope you enjoy the video.